From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB. I'm Juliette Sarli on a day where we saw a little bit of a reprieve coming through from markets, although we did give up a lot of those earlier gains in the afternoon session. Of course, a bounce on the open as we heard word from Canada's Justin Trudeau on platform X that tariffs expected to be imposed on Canada are going to be delayed by 30 days, similar to what we'd heard from the expected tariffs on Mexico as well, following conversations between the Mexican leader and President Trump as well. We had a really good session coming through from tech players today. Let's just get into those themes of the day, because tariff trato certainly gave a bit of support, trato Spanish for deal, and of course the tech companies really leading the gains as well, supporting the overall market. We've also got spending spree there because household spending data was released today, showing that it rose for a third straight month in December, up by some 0.4% from November. Annual growth around 4.3%. The Bureau of Statistics saying spending was driven by new car purchases, dining out, air travel and streaming services. So consumers getting more confident ahead of an expected interest rate cut from the RBA this month, and of course a raft of economists just really changing their calls to that February expected cut, including HSBC's Paul Bloxham, who joined me earlier today. You can find that interview up online. He's actually moved their calls from Q2, Q4 to Q1, Q3, so they're expecting their first cut to come through in February, although saying that the meeting is very much going to be on a knife edge, and of course the implications, the whiplash we're all getting from Trump 2.0 about potential tariffs could be the biggest threat to global growth. Let's have a look at the sectors of the day. I mentioned the tech stocks had a great session, kicking it off with WiseTech up by 3.4%, Technology One was up 2% and Zip rose by 4.2%. The miners also had a pretty good session, rebounding from some weakness yesterday. In particular, Rio Tinto up 2.5%, while South 32 was up by some 3%. And on the flip side, we're watching a little bit of weakness coming through in some of those energy prices. Global oil very much still volatile trade, 1 month low for the Brent contract. NYMEX holding around $73 a barrel. Beach Energy, which reports this week, was up 0.5%. Well, Telix Pharmaceuticals hit a record high. It says it's been unaffected by US tariffs despite most of its revenue from US sales of Illuccix, its prostate cancer diagnostic drug. Woolworths shares a little lower. It's overhauling its retail arm and has appointed new executives to head its retail and New Zealand divisions. Meanwhile, we had Seek edging higher by around 0.8%, but Xref shares fell because Seek's proposed acquisition of the software firm has fallen through. The HR and recruitment company saying the offer from Seek wasn't approved by the required majorities. And Nufarm says its cost-cutting program remains on track. The agri-chemicals firm previously flagging to the market it aims to achieve $50 million in annualised cost savings after recording a fall in revenue and profit across full year 24. And the stock of the day was Nufarm. Koshi was joined by Sean Hickman from Market Matters and Mark Morland from Value3.com.
Earnings have been going down, surprise, surprise, the share price has been going down with it. I just see no reason to buy the stock. I think actually the chart you put up there has probably been kind. If you go back a bit further in time, it looks far worse. To me, it's a sell. There's no reason I can see to own the stock, I'm afraid.
And they've got less than 1% return on equity. I mean, it's like they've got hopeless returns on capital, 0.5% on their capital. So this is a business that I've only got 10 years history. I suspect it to be the same going back even further, but I don't know. But anyway, look, it's on an 80 PE. Now, why is it on an 80 PE? The market has been kind to it because it should have smashed the price down a lot further than it already has, because their earnings have dropped so much that it's just like I don't see any where the hope would be. So even if you could pick the cycle, let's say it's a cycle low now, and if you could believe that, I don't know. I wouldn't buy it anyway because they've got a total history of never performing.
All right, right, let's welcome to the COB Mathan Somasundaram from Deep Data Analytics. And Mathan, we've lived through this before. We're going to have a little bit of whiplash over the next 4 years, I think.
Yeah, we had a phenomenal less than 1 day trade war. Just
We survived.
no, it's just I saw someone on Twitter put up a picture of a T-shirt that said, "I survived 2025 trade war. Started on the 3rd of February, ended on the 3rd of February." And I think that's pretty much where we are. It's a reality show, and nothing is going to surprise us anymore. And I think it wasn't a surprising factor. It was a bit. I mean, I think we'll go back to it. We'll have another version of this in 30 days. It's an attention grabbing play. The reality is they need a lot of cost cutting, or they need to increase taxes to pay for the tax cut, income tax cut they want to push through. So it's a simple strategy of you need to find $1 trillion out of the budget, and the budget discretionary spending is 1.7 trillion. So to find $1 trillion, you got to come up with a lot of new taxes. So we're going to have tariffs. Whether they survive or not is another question. Europe knows it's coming, and inevitably Europe will retaliate. And if you have a bad market day, then Trump will probably delay that one too. So we're in that game, up and down. You know, it's a reality show that's going to play out, and sadly the market are dependent on it. So we're going to be going up and down.
Indeed, and you know, any of those headlines like we saw yesterday with the likes of Cettire, Fisher and Paykel hitting those companies hard, what do you look at in terms of, I guess, playing the longer game? Because some of these impacts, as you say, there's going to be ups and downs, but they could be quite minimal, at least for Australian listed stocks.
I think it's going to be very specific. I think the US aligned ones will have issues. I mean, think about it this way. Most Western economies, the bottom half of the population is really struggling, and they've been surviving on debt. And the governments around the world have basically run historical high debt levels to support the economy. And the cost of debt is going through the roof. Yes, central banks are looking to cut. We're looking at any excuse to cut, like RBA, even though the data completely does not back it. But we're going to get a cut for the wrong reason, and we probably might only get one cut, because after that the inflation goes up and they probably stop. Now, the problem here is the Fed cut 100 basis points, bond yields went up 100 basis points. So in reality, we got nothing out of it. So that's probably the risk here, because the central banks have been so bad. The bond market and the currency markets have taken control. I mean, look at Japanese yields, they're flying through the roof. Japan has to raise rates multiple times, and that'll put pressure on the overall economy. So the global economy is in a weak growth cycle, and it's going to get pushed even further lower. And US is at the top of that. US has outperformed the rest of the world, so there will be a catch up on the downside. And I think the consumer linked, I guess global growth linked US players will struggle. So I think you have to be pretty selective. We've taken a position that we wanted to stay away from most of the US businesses, because that's going to create a lot of volatility. Even in healthcare space, we've chosen Sonic because majority of the business is Europe, and it kind of gives us a bit more defensive nature to it. So we're not surprised. I don't think this is over. There's going to be a lot of volatility. You're not going to invest money into areas where you got multiple years of volatility ahead.
That really puts paid as well to what we look in terms of moves from the RBA, which a lot of economists are moving forward their likelihood that we will see a rate cut, because there's a lot more uncertainty out there on the global growth picture as well. But just on that front as well, when you're looking at being selective, what do you think about some of these consumer discretionary stocks if there is going to be a rate cut, and we have, as I mentioned earlier, seen household spending tick up?
Yeah, I mean, in the Aussie market, the retail sector, it's the haves and the haves not. The good ones have outperformed quite a bit. The bad ones have been smashed. The good ones are, you know, everyone's market darlings like Premier, Lovisa, they've all downgraded. The cyclical nature of it, a lot of the ones that have linked to the property cycle have done well, but we can already see property prices rolling over. I don't think one rate cut's going to change that dynamics. I think we're in a bigger trend, and I don't think the bond yields are going to come off. Now, the banks are cutting fixed rates because over the long term, economic slowdown will get rates down a bit, but it's not going to take it down that much, because if they truly believe that there's going to be a lot of rate cuts, they would be cutting variable rates. and no one's cutting variable rates. So that kind of tells you where we are in the cycle. So I think consumer sector, anything linked to consumer sector, anything linked to asset prices are going into a tough 2025 because bond yields are still pretty high. Growth is going to go lower. Unemployment is historically low. It can only go the other way. So in that context, RBA cutting is not a logical thing because if they cut at a time when the Fed is not cutting, Aussie dollar, which is already below 62 cents, is probably going to go even lower. And we don't make many things in Australia. We buy everything overseas. And as the currency keeps going lower, inflation will go up.
Now, we just hit a key point in terms of midnight on the East Coast, so 4 p.m. our time. Those tariffs on China now coming into effect. We've seen the US dollar extend those gains against the offshore yuan, the Aussie dollar declining, S&P E-minis and NASDAQ futures both falling as well. So as we said at the top, it's going to be a roller coaster, but it certainly looks like there could be maybe some retaliation from China, and that will play more closely into our market.
Probably. I mean, China did say from day one that if they do have substantial tariffs come towards them, they are willing to let the yuan devalue. And if the yuan devalues, so does the Aussie dollar. It's just a historical correlation because of our business model. So in that context, it's not really a surprise that this is playing out. They only put 10% tariff on China. That's a rounding error. I mean, we were flagged like 60%. 10% is, that's just
a slap on the wrist.
So, exactly. It's a pillow fight. So I don't think that's going to change the dynamics too much. But I think what the market was positive on the miners today more than the rest, mainly because they were expecting 60. When you do a backflip on Canada and Mexico, the chances of Trump going hard on China is probably a lot less. I think the next target, the natural thing is he's going to pick on the weak one. So Europe is a complete mess. So we're going to get tariffs on Europe, and Europe will probably retaliate. So let's wait for the next saga in reality show.
All right, indeed we will. Thank you, Mathan. Until the next episode, for your time. Mathan Somasundaram from Deep Data Analytics. All right, let's have a look at the market leaders. Vault Minerals up 5.2%, Pro Medicus up 5%, Megaport, Gold Road and Liontown Resources all looking good. To the downside amongst the large caps, Audinate had a bad session, Neuron Pharmaceuticals, Linus, AUB and Centuria Capital. In the small end of town, a good rise coming through from Energy Transition and Antipa Minerals, while on the downside, in the small end of town, SPC Global. Remember Stuart Roberts was telling me on Friday that's one of his favourite picks. It was down 21% to 60 cents. Vinyl down by 7% to 10 cents. All right, a lot happening on Wall Street as well tonight. Of course, we continue to watch the impact now that the tariffs on China have come through. S&P 500 E-minis falling 1/3 of 1%. NASDAQ futures down 1/2 of 1%. We've got JOLTS job openings, also US data on factory orders, and a number of earnings including Alphabet, AMD, PayPal, Spotify, Snap, Pepsi, Pfizer, and Amgen, along with Chipotle as well. So a lot of earnings coming through. Tomorrow we have AMC and Amcor and Karoon with their updates, but no major market moving data. The local market finishing higher, by 1/3 of 1%, but off its earlier highs of the day. And I think we were probably buffered by the fact that we did close at 4, just as we saw the impact of the tariffs on China coming through. The Nikkei has been pairing its gains, I should say. S&P 500 E-minis falling 1/3 of 1%, NASDAQ futures down 1/2 of 1%, and the Aussie dollar dropping by almost 1% against the greenback, 61.76 cents, while the dollar extends its gains against the offshore yuan, last up by around 1/3 of 1%. As Mathan said, we will wait to see what the next episode of Tariff Turbulence brings us, but until then, we will catch you from 9:45 a.m. Eastern tomorrow.